Roger Montgomery from Montgomery Investment Management. Well, what's the conundrum that investors face today? Let's look at two parts of the investment equation. The first one, the economy, which obviously drives some of our returns, and then let's look at prices and other factors. On the economic front, it's just all good news at the moment, and seemingly nothing can go wrong. The US economy is now growing at an annualised 3%. In fact, globally, the Western world economies, or the leading economies, are expected to grow by above average rates over the next 12 months. Inflation is yet to emerge, despite the fact that wages are starting to pick up and capital expenditure all around the world is sucking in the underemployed and unemployed. So employment's improving, growth is picking up, and inflation appears to be nowhere to be seen. All this is obviously very good for markets. So from Germany to South Africa and right around the world, developed economy markets are doing very, very well. Here in Australia, the Reserve Bank met during the Melbourne Cup, and in their notes that were published the next day, we could see the same conditions that I've described for leading economies of the world are also occurring in Australia. We've got emerging growth, we've got low declining unemployment from 5.5% currently, we've got capital expenditure and business confidence improving, we've also got massive infrastructure which will support state economies, and inflation is nowhere to be seen. So with all this going so well, why should we be cautious? Why should we be worried at all? Well, it's just this. Even though earnings are growing more strongly than they have in the recent past for listed companies, prices have gotten well ahead of themselves. Prices are not only reflecting high growth over the next 12 months in earnings, but continued high growth in earnings in an uninterrupted way over the next decade. In fact, when we look at some companies like Cochlear and CSL, for example, we really have to assume high double-digit earnings growth continuing without interruption for a decade in order to justify current prices. And that's just unrealistic. So that's the first warning. The other warning is we're seeing exuberance starting to creep back into markets. We saw the American Airlines CEO say recently, and I quote, "I don't think we'll ever lose money again," end quote. And I'll have to read the WeWork one because it's just completely unbelievable. WeWork, which is obviously a unicorn in the United States and a listed technology company, their CEO commented, and I quote, "Our valuation and size today are much more based on our energy and spirituality than it is on a multiple of revenue." So when energy and spirituality start being used to justify market multiples or market capitalizations, that's a red flag that investors should be aware of. Also keep in mind that there are 28 companies in the US stock market listed on the S&P 500 trading at more than 10 times revenue. And prior to the tech wreck, the total number at that multiple was 29. And also keep in mind that when I looked through the NASDAQ 100, before I got to the letter E or F, I found more than a dozen companies trading on PEs of more than 250 times. On their own, high prices don't mean anything, and it isn't an indicator of an imminent crash. But when you've got the future priced in perfectly, and sorry, I should say a perfect future priced in perfectly, when that happens, there's not a lot of upside left, and there is potentially a lot of downside from anything that comes out of left field. So yes, the Goldilocks economy is supportive for markets right now, but prices are factoring in a future that only considers Goldilocks conditions to continue. I look forward to seeing you again next week. In the meantime, please follow us on Facebook and Twitter.